we're going to start right off with our questions via email, and then we'll get to the few questions that came in. Vin commented in, says, good evening. Good to see you, Vin. I'm glad you're here. All right. And we've got some other questions and comments from Robert, it looks like, and Nilesh as well. And we'll get to those. But in just a moment, let's go ahead and talk about Henry's question. Henry has an OTM short option. Not sure if it's a sold call or sold put. Doesn't matter. It's expiring today at 8/7. Now, Henry wanted to know, should I let the option expire, take the full profit from the position, and sell Monday for next week? Never a bad strategy. What do you miss by doing that? Well, you get the full value of the call or the put expiring worthless, Henry, and if you sell the new call or put on Monday, what you might have just missed is 1 or 2 days of time premium. But I'm going to come back to that in a moment. Should you, too, buy the option back late Friday for little money and no commission, about 65 cents, and then sell Friday for the next week, which is what you usually do? And that's a good strategy also. You also mentioned roll at some earlier time. Now, my thoughts on this, and I think Ernie would say the same thing, is related to 2 or 3 is what you might find yourself more commonly doing. And you mentioned that you use number 2 more often. Our preferred goal is 80% profit. So if I hit 80% profit on what I expected to make on, say, a naked put trade, Henry, or even a bull put credit spread, if I can close early, I will close it early, take that profit off the position, and if I still like the stock at that time, I might look to roll up to a higher strike. This is with a naked put, of course, that's still out of the money, still matches the probability I'd look for in that naked put position or that bull put credit spread, for example. And if I get 80% of the profit, 4 or 5 days before expiration, then yeah, I might close the position and roll it at that time rather than waiting towards Friday of expiration. But that's the target we look for. There's nothing wrong with doing option number 1. As I mentioned, if you let the option expire, you get the full profit, and then of course you sell on Monday. What do you miss? Maybe that 2 days of extra time value. If you're doing weekly options, Henry, that might actually have a big effect. It might be 10 to 15 cents of time value decay, which might be a big amount percentage-wise of the weekly premium you're collecting. Another subtle advantage of doing this is, of course, in this type of market, we've seen it happen maybe once or twice. But I let the option expire Friday, then I look to sell it again on Monday, maybe on the same stock or using the PowerOptions search, whichever position matches my criteria at the time, for whatever strategy I'm using, of course. But something changes over the weekend. Some bad news comes out, the market opens up down Monday, down significantly, or a lot of volatility spikes up. Well, I hadn't sold the call yet. I can wait for the market to hesitate now, or sold the call or the put, excuse me, Henry. I can wait for the market to settle down, see what I feel about the market conditions, and then look to sell. If I had rolled it on Friday and then over the weekend that occurred and the market sort of fell, if I was doing naked puts or bull put credit spreads, then I might be in a position where I might have to close or roll that position already, but that's in a severe situation. The one benefit of letting expire, of course, getting the full profit, waiting for Monday just to see if anything changes over the weekend in this type of, hesitant market. So which one is preferred? Well, personally, just like you, I probably do all 3. A lot of times I'll let my bull put credit spreads just expire worthless, then for full profit and look on Monday. However, 4 to 5 days to go, if I can close the position and still keep about 80% of my expected profit, I might do that, or I might just roll at the same time if I still like the stock for the strategy that I'm using, naked put, bull put, or even if you're doing naked calls, for example. But again, I'm targeting that 80% rule for the profit on the position or the profit on the premium, and that's what I'm going to look to achieve. That's when will dictate for me if I'm buying it back and then rolling again, or if I'm going to roll at some earlier time. Okay, so all 3 are acceptable. All 3 are good approaches. I'd say if you're, what I find myself, excuse me, Henry, doing the 2-week out options, and Robert's got a comment on that we'll get to once we address our other 2 comments here via email. But doing the 2-week out bull puts, I might only be getting a net credit of 25, 30, 35 cents or so on a 2 or 3 or 4 point spread. So even though 80% profit is my target, if I'm on the Thursday or Friday, 1 day to 2 days to expiration, and I'm still confident in the markets, I probably won't close that early. I'll let it go for the full profit to target the return that I initially wanted on the position. Okay? If you're doing weeklies, I think you'd want to maximize that profit as much as possible by letting it expire, but then again, you are missing perhaps the 2 days of extra time premium by waiting to Monday and then selling the new position. All right? Okay. All right, so that's my answer for Henry there. Regarding the closing or rolling, I find all three to be acceptable. Give me just 1 second here. Okay. All right. Just 1 second. Oh, good. Okay. All right. Okay. I just want to see if there's any comments on that discussion. Now, this one might relate to some other ideas, but Robert's question via email, he says, can you compare the pros and cons of buying a long-term call option, maybe 12 to 18 months out, at a price and strike price as close as possible to the stock price with a delta around 70 to 90? I think what he means there is with pretty much little to no time value with as much intrinsic value as possible. Versus buying the stock with a Married Put structure, more buying power versus a dividend. And I did answer Robert via email, but we're going to take a look at two different positions that sort of illustrate my thoughts. We'll get right to that in a moment. We're going to use the portfolio to show the two comparisons, and then we're also going to use that to help Mark. I emailed Mark today, and I actually emailed him the other day as well. Mark's having an issue with a NVDA covered call. He's got stock at 204, and he's got a 300 call. The stock's at about 445. So for January expiration, it's about 160 days out. Now, he knows he's locked in the price, but he's looking at the Thinkorswim platform, and he's saying that it's making money now, but when the stock goes up, he's going to lose money, and when the stock goes down, he's losing money when the stock goes down, and he's under the impression that the most I can make would be the difference between the 204 and the 300, and that's correct. He says, right now, it appears I am making more money now, and if the stock goes up, then I waited until January expiration, which is not correct. We're going to see why. We're going to walk through that, and then see maybe why he's not seeing it the way he thinks it should be appearing. Okay? So let's navigate over to Power Options, ladies and gentlemen. Don't worry, this isn't going to be a long conversation here. It's going to be a thorough conversation, but it's not going to be long. So I know we've got those other questions and comments that have come in, as I mentioned, from Nilesh and from Robert. We're going to get to those in just one moment. All right, so here we are at the Power Options trial. And what I want to do right now, of course, is navigate to the portfolio. We're going to go into the portfolio tools. Now, what I've done here, if we could ignore the NVIDIA position for a moment, what I've done here is entered in two positions. This is for the comment on Robert. And we have a winner and we have a loser. Okay, so comparing buying an in-the-money call with a high delta versus how we might structure a Married Put position. Okay, so the first one on July 1st, we took Fabrinet, and Fabrinet was trading at 61.26. The delta of 70 to 90, right in the middle, 80 delta at that call, was January 45 strike. And this was priced at $19. Okay, so even at a delta of 0.8 on this Fabrinet position, there's still about $2 to $3 worth of time premium in there. With the stock at 61, we're roughly $16.26 in the money, so about $2.70 of time premium. You're still going to have some time premium. You're not going to see, even if you go up to a delta of 0.9, there's still going to be some time value, especially if you're going out 12 to 18 months. That's just the way it is. But okay, I've got a capital investment of $1,900 for one contract. And of course, we'll take a quick look at the profit and loss chart for that position. As we'd expect, we've got $1,900 invested. We're risking the full amount, 100%. We could lose 100% of what we invested into this position as a long call trade. It's not a bad call trade, deep in the money, high delta. On July 1st, what I might have done as radioactive Married Put is bought Fabrinet at 61.26 and at the same time bought the January 65, keeping the same expiration, for $9.85. This gives me a similar risk-reward structure, but I'm not buying the deep out-of-the-money 45 put, which would be a fair comparison. I'm structuring this as I would as a radioactive trade. Risk is a little bit higher than I probably would have liked, but Here we are risking 8.6%. Did I invest 5 or 6 times, roughly as much as, well, not 5 or 6 times, about 3.5 times more, 4 times more than the long call? Yes, it did. Long call was $1,900. I'm in for $7,111 with the married put structure. What is the long call risking if the stock goes to zero? $1,900. What am I risking on the married put? $611 or 8.6%. Okay? So what is the difference? As Robert mentioned, is it just buying power? Well, yes. The long call, of course, gives you more buying power. Can't argue that. I've never argued that. But it does have this comparison, this increased risk. See, if I did do the out-of-the-money 45 put and only paid $3, well, stock has to fall 20 points or so before that insurance is triggered. So that would be close to the same risk of $2,000, $2,100 that we would be just buying the call. Okay, that's just the way it is. But we wanted to do our comparison of what we do. So the long call gives you more buying power. With that, of course, comes what? It comes with the threat of higher risk, not just monetarily. Okay, so we paid $1,900 on the long call, $7,111 to get into the married put. Let's say we both had $10,000 to invest. Are you just going to buy one contract of this call on the stock you like? Or are you maybe going to buy 2 contracts and be at half the price of what I'm looking at? Okay, now you're risking $3,800. Or are you going to take, of that $10,000, you put $2,000 roughly into one, are you going to buy 5 more calls around the same price? So you've got 5 positions where I might enter another married put here at $25 or $25 stock, and I only have 2 positions. But each of my positions is only going to risk 5, 6, 7, 8%. You're risking 100% on the 5 positions you put in here. Okay? So you've got more buying power, but that also leads to the potential for over trading and the chance for leveraged losses. Okay? Now, I understand. I do long calls too in the money on stocks that I can't afford to do a married put. You know, Netflix, Amazon, Tesla, Booking.com, for example. I can't afford to buy the stock and do a put, honestly. It would take up all of my portfolio essentially to do that with 100 shares. So yeah, I'll use long calls occasionally as well. There's nothing wrong with doing that. But long term, we have to appreciate the fact of what we're doing. How did Fabrinet turn out? Well, as you can see here, Fabrinet's now at 76.25. It's up 24.5%. Your long call is making almost 70%, up $1,300, and the married put's lagging behind. It's a 13% return with $924. But at the same time, and I know this is a cheat, but we want to show it side by side. On July 1st, if you bought a 2021 June, this is 315 days out, 27 strike call on UVXY, which was trading at 31.31, that was a delta of 0.8 again on July 1st, with the stock at 31.31. It would have cost you, again, about $1,900. UVXY, we're going further out in time, but at the same time, UVXY does have a higher volatility. You'll see that in the married put risk. And so you're deep in the money with the delta you want. You paid $1,900. On July 1st, I would have bought the stock at 31.30 and the June 40 put at around $21, okay, as a married put structure to keep it into the risk. Now, this is double the risk I would normally take on this position, okay? Well more than double, so about 3 times more than I would normally take on a married put position. But this is the range essentially in the money I'd look for. This goes back to the high implied volatility. I wanted to show you the risk of the married put in this case because you have a high cost and high volatility on that long call in UVXY, and I have it here on the married put position as well. It's 3 times more the risk I've taken. That call that we saw at 1910, just 4 points in the money, so 15 points of time value for at the time about 360 days. That's a lot. But that's the price we would pay in the security. But as we kind of saw, where are we? This one went down. UVXY went down 28.5%. So here you are at a loss of 43.5% on the position. on the long call. The Married Put is at a loss of 7.4%. Okay, now, liquidation value of the two positions. You could liquidate the call right now for a profit of 69.5% or $1,320 and close the other one for loss of $830. So you've got a gain of about $490 if my math is correct. Yes, $490 with these two positions. Okay, leverage works for you and of course against you. That's why proper position sizing is always key. Now I only made $924 in my Married Put to your $1,320 on the leverage gain on the long call, but I lost $386 on the position. So my profit is about $540 or close to it, $538. It's not much difference, but overall, that's sort of the difference. Leveraged returns also lead to the potential of leveraged losses. When you see a 10% drop, even far out in time with a high in-the-money delta, 0.7, 0.8, or 0.9, Robert, what you'll end up seeing is still maybe a 20, 25, or 30% loss. If you see a 15% loss, you're going to be around 30 or 35%. The stock falls down 24 or 25%. You're looking at a 43 to 50% loss on that position. Okay? So that's why these things come into play, where you have to be careful with the risk on the position and the proper position sizing as well. Okay, so real quick here. All right, 1 second. I'm just making sure there's no comments on this. I see a lot of questions coming in here, so we're going to have to go through that. No problem. All right. That's Williams. I'm just scrolling through. Good. Okay, so no comments on this one. Now, I saw a comment in there. Can you illustrate an in-the-money covered call? Well, the tools for it, yeah, but what we're going to show now is we're going to jump back over to Marc's NVDA position since we're here on the portfolio. I don't know the position that Marc entered, okay, as well. Oh, Vin's real quick question here. What is the max risk you take on the Married Put position? If the time value. The time value on the Married Put position, you know, the max one on the UVXY was 23.7%. With that 28% drop down, it's only down 7%, Vin, okay? For the structure I normally look for in a Married Put, I'm looking for a risk between probably 4 to 8%, 3.5 to 8%. Usually I like to be around the 6.5% range if possible. This is a little bit over. At the time I entered this trade, the price was $9.85 for the 65 put. Yeah, about $3.74 of that is in the money. So the remaining $6.11, the time value on the put is the true risk. The stock could go to zero, and I cannot lose more than that $611. Stock could go to $1 per share. I cannot lose, guaranteed, better than a stop order, more than that 5, 6, 7, 8% on the position. Okay. All right. So related to the NVIDIA long call for Marc, I didn't know the premium he received. I just used a premium of $50. So again, just as a date, July 1st, we had NVIDIA shares at 204. We sold a far out January 300 call for $50. All right. This is the in-the-money covered call position now because the stock's up to $448. Now, when I looked at this position earlier, what we were looking at, okay, so now it's at, we'll have to check it, of course. So it's at 448, let's call it, 2 cents off. We're going to call it 448. So that means the intrinsic value on our 300 strike call is $148. Okay? I almost said $14, but it's $148 total. Now I'm going to go to the options real quick. And January, 300 call, excuse me, there it is. It's 156.50 to 159. So let's call it a midpoint of around 158. So that's about the same numbers I gave to Marc when I replied to his email at 158. So what are we looking at here? If I went to liquidate this position right now, I could, let's clear that out. I'd buy to close the call for $158, and we'd get $448 back for selling to close the stock. So whatever our cost basis was, we'd have a value of 290. Okay? If the stock continues to move up, what's going to happen to the call? Well, that $10 time premium is going to decay. It's going to get lower and lower, and the option is going to have a higher delta, and it'll go to intrinsic. So as the stock moves up, you're getting closer to the max return of $300. If the stock falls, your option premium will decrease, but it's not at a 1 delta. The stock's at a 1 delta, so you're going to be losing more on the stock than you're gaining in the decay on the covered call. So if the stock is moving down, Mark, your liquidation value is going to decrease. The value of the call is going to decrease, and that works in your favor because you'd have to buy it back. But at the same time, if it goes down to 290, oh, sorry, that's way too far. I'm sorry. If it goes down to 400, you're going to lose $48 on the stock, and you might only lose $36, $38 on the call. Okay? It's not going to necessarily work in your favor from where it is now. But now, as you see, if you close it, you're only getting 290. If it continues to go up, this is going to get closer to intrinsic, that $10 time value that you still have, right, the 158, and you're at $148 intrinsic. As the stock goes up, your call is going to gain in value, but you'll see this time value go lower because you're getting closer and closer to a delta of 1, just intrinsic in that case. Okay, so well, you know what your liquidation is right now. Well, these are based on my numbers, Mark, but yes, as the stock goes up, you should be getting closer to the 300 maximum profit you're expecting. What can you get back at assignment? 300. Difference of 96 from where you sold the call. As it goes up in price, you're going to get closer to that. If it falls, liquidation value-wise, you're losing dollar for dollar on the stock, or maybe only 70 cents you're gaining on the buyback cost of the call for every dollar the stock drops. So your liquidation value would actually lower as the stock price lowers. That's how it works. Now, what you might, there's some confusion on what you're seeing on Thinkorswim, it might be they're just showing the short call as sort of a naked call, not reflecting it as a total covered call position. I'm not sure. Again, best team to ask would be the support team at Thinkorswim for them to help you navigating those tools if possible in that case, okay? All right, so let's see here. Let's just go back to the top. That was all the questions I had via email, and I've got several questions and comments as well. Okay, so Robert G, different Robert than sent in the email. I'll just leave that there. Robert G sent a comment. I wanted to thank you for focusing me on the bull put strategy. 2 weeks to expiration, 15% profit. I made $7K in 8 weeks on $30K capital. Robert, that's excellent. Of course, bull put credit spreads, the weekly bull put credit spreads I use, the 2 week out spreads, Robert, have been doing fantastic for me since April in that case. One little hiccup that I had to manage a couple positions recently. But that's very good. I'm glad, Robert, the bull put credit spreads have been doing well for you. That 15% target return is sort of what I look for in my positions as well, and over time with the 85% probability, as we discussed last week in our discussion for the bull put credit spread criteria. Okay. So there we go. All right. And Jesus wrote in, as Jesus or Jesus, I'm not sure, is there an option to search for long calls for undervalued stocks? Well, you can set one up very easily. We don't have a default one because our testing has actually shown, Ernie's testing that he did, like we did for the picks of the day under covered calls and naked puts, and the trading and testing I did for the bull put weeklies that are 14 days out that we're seeing right here. We've actually found long-term that trying to bottom feed or look for depressed stocks, which you might determine as undervalued, but stocks that have been declining, hoping for a rebound and buying calls on them, does not actually work as well as looking for the stocks that are showing the simple moving average that you want, showing a bullish trend, maybe near the top of their Bollinger Band or had a recent Bollinger Band breakout. We've seen those work better, okay? What you could do is just go into the search, start off with, say, the initial value screen, keep the option criteria if that's what you want. Okay, but you could adjust it for the time frame you want, price that you want, Black-Scholes ratio or delta range that you want as well. And then we just clear out some of the fundamentals, and you can clear out the stock price as well. And we can look for stocks. You can scan for stocks based on, price to book or price to sales. If you wanted to see undervalued positions related to the price to sales ratio or the PEG ratio even as well, you could put that in also. Now, if I wanted to look for more depressed stocks, you're talking about reversing it. So I might look for positions where the stock and the 20-day moving average is below the 50-day moving average, where we're near the bottom, let's say in the last 30 percentile of the 52-week range. And then again, I might use some of these other ones, but we'll just leave it at that. Look for stocks that have declined recently, but still match our call premium. And so we've got Belden and Peoples, SLB, of course, Schlumberger is down there. We know why. Brooklyn Bank. I was expecting to see some more retail positions in here, but I guess not. And that's okay. So let's take a look here at the chart. Oh, so that's not too bad. Let's go to a 6-month chart here. That's fallen recently, but it's still within a strong channel there. There we go. That's what I was looking for. So we've gone down from about 35 to about 20, and it's channeling right now. So this might be considered undervalued because it's normally up higher in this range when that sector and that industry is doing well, which it hasn't been. Okay? But that's how you can do it. Just take one of the defaults. Don't worry about changing the option criteria. Look for some of the reverse values where stocks are in the lower range of their percent 52-week range, stocks trading under their 50-day moving average. Might even use a lower MACD, where the MACD is under by at least 2 days or 3 days or so, meaning the MACD is crossed under the signal line. That's some of the fundamentals we reviewed last time. But you can, in the fundamentals, use some of those price to sales view, price to book to look for what you might consider undervalued based on those ratios as well. So there's not a default screen to look for that. Our testing hasn't borne out that looking consistently for bottom feeding stocks is consistent enough return as compared to looking for stocks. That being said, as many of you know, back in March, near when we thought we were at the bottom, March 27th or so, we put up that webinar about what Ernie and I were doing now. And we were both sort of looking at long calls on quality stocks. I was looking at Costco, Clorox, some other things that I thought would benefit over the next few months. He was looking at Apple, Microsoft. What was it? It wasn't Home Depot. It was something like that. Lowe's or Home Depot. I can't remember which one. So that's when we were bottom feeding because it pulled the whole market down naturally as well. Okay. And there's nothing wrong, again, with that strategy as we talked about in Robert's discussion with that. But again, of course, you've got to take into account if the stock continues down or continues to stagnate, you could be looking at a significant loss, 10% drop. You might see a fair amount of decline on the position on the call. The leverage works both ways. I'm just going to answer this. I'm not going to walk through it. Nilesh, I'm sorry. I don't have a way to do this right now, but I'm going to jot it down and we'll talk to the programmers about it. Nilesh said, is there a way to calculate risk-adjusted returns on the portfolio if we use Married Put as a core strategy? And unfortunately, no. And what he's talking about there relates to what Vin was asking. So on that Fabrinet position, I knew that the maximum risk was that $611. And on this one here was much higher, it's about $2,000, I believe. But if I'm making making $939, we're showing that percentage return based on the total cost of stock plus put. I believe what Nilesh is asking is if I had a $939 profit, but my true risk was only $611, is there a view in the portfolio that shows that? And unfortunately, Nilesh, there isn't. But let me make a mention of that to Ernie and the programmers, see if we can maybe get a little bit of enhancement there in the portfolio if you preferred to view it by risk adjustment. Going back to Robert G's thoughts, not the Robert that emailed in, but Robert G's comments on the bull put credit spreads. Sam adds some comments. It says, 8th bull put in Apple was a full credit, even with a drop of 1%. They've been doing about 8-9 trades, of the Apple bull puts. He says, my Apple bull put account is up 70% in 2 months, not too shabby. And that's sort of what Robert was talking about as well, the gains that he had seen on the bull put credit spread. So that's excellent, Sam. I'm glad that's still working out for you as well. Okay, let's see here. Okay, so Frank, this was Frank's comment. We saw the power options, the NVDA position for Marc. But Frank asks, can you use Power Options to illustrate in the money covered call? Is there a tab for that? Well, if you go to the search, since there's strategies within strategies, Frank, if you go into the search in Power Options, you'll see that we have several defaults for you. The picks of the day that Ernie tested and the weekly picks of the day as well, monthly and weekly. But we also have defaults set up for you for an at the money covered call, in the money covered call screen, and an out of the money covered call screen as well. So just use the in the money as your default, and then you can adjust, as we just saw, the technicals and fundamentals for that as well. Now this is going to the standard expiration, but if you wanted to go more weekly or look 10 to 20 days out in time, you could just change the time frame there to see any of the weeklies or even to August standard expiration, as well, and run that search. Oh, good. There it is. Okay, great. Sorry, I didn't think it had come up for a second. My apologies. And so here are the positions that match. So what would I be doing with an in the money covered call? Here's Harley Davidson, which has had some issues recently, of course. We can buy the stock at 26.21, sell an August 22 call for maybe a midpoint of 445. Now for 21 days, this is only going to give me a 1% return. But I have a 17% downside protection, meaning stock can fall 17% before I'm technically losing money on the position. And I've got a 94% chance, probability above, of making that 1% return in 21 days. Now, before I go to the profit and loss chart, let's just go to the option chain. And what's the advantage? That was 21 days out, I'm sorry. What is the advantage of an in-the-money covered call? If I can buy the stock at 26 and sell the 26.50 for $1, have a 4% downside protection, and potentially make 4.3% or 5% return if the stock goes above 26.50, why wouldn't I just do that? Why not take this one here, a nice 2-to-1 sort of protection to reward ratio, selling at 25.50, I could make 3.7% if assigned, slightly in the money, with a 6.2% downside protection. Well, we only have about a 59% chance that the stock would stay above that price. Now, this might be too deep in the money, but again, that covered call that we saw, we have about a 94% chance of making that 1% yield in 21 days. And we've got 17% of downside protection. So the covered call screen and the covered call strategy, you have to decide what best suits your needs. Do you want a little bit more downside protection but still targeting a 1, 1.5%, 2% return for 14 or 20 days? Are you comfortable with sort of a 1-to-1, maybe a 5% protection at the money with maybe 4.5% return if assigned? Or are you more speculative and you think the stock might continue up? You're comfortable only taking a 2% risk with the out-of-the-money call, but still the potential to make 9, 10% if the stock goes above that strike price. Okay, but that's the covered call there, and again, sort of the discussion, and let's go back. We'll just take a look at the quick profit and loss chart there, Frank, for that HOG covered call. There we go. So we've got a lot of protection, a good percent to break even, or the percent downside protection, we call it, with a covered call position. High probability of making the 1% return as well. Okay, and let's see here. There we go. Okay, so this is going to take us now, I've seen the money covered call discussion, that's going to take us to Dan. I'm going to go in order, but after Dan, let me scroll down to the bottom first here, Dan. Oh, sorry, folks. Okay, let's scroll down here. Okay, great. Okay, so Nilesh, you're welcome. We'll take a look at that there as well. Okay, all right. All right, great. Okay, so Dan, YRI.to, $2 call, January 2021, paid $271, currents at $555. A registered account, so I can only buy options. Should I buy puts to lock in the profit or get out to find something else? I think gold will continue to move up, but retracement is possible along the way. If puts, what time horizon should I choose to optimize the cost benefit? Okay, well, I'm not going to use that example, of course. I don't think I have the data on it. let's take that long call we were winning on in Fabrinet and walk through some examples here. All right, so the question is, we've got this gain in the long call. And we saw the leverage gain. Now, there's a couple things we could do. If I was going to buy a put, and because you had mentioned here that you still think that gold's going to continue to go up, but retracement is possible along the way. If puts, what time frame? I'd say keep the same time frame, personally. Create sort of that strangle position where you might have no risk on the strangle. I had a discussion with Fernando about that earlier this week via email. But the stock, so our stock has moved up to 76.40. You saw we had about that 63% gain on this position. Absolutely. One thing to do now is I'd probably go out to January. And I might go right at the money, or you could even go out of the money. See, if I go to the 65, I'm locking in about 20 points of potential profit between the strikes, and I'm only paying $4 for it. So it's kind of cheap, but I'm still well above the call strike price. Let's take a look. This is going to add to our time value, yes, but at the same time, yeah, so that max risk now goes down to 310, pretty much close to the the total cost minus the 20 points I've locked in between. Okay, if I went higher, I'd probably have a no-risk straddle, but at that wide, what we call dead zone, right? So if the stock does retrace and stay in here, we have a wide dead zone. As always, you could continue to manipulate the call and the put. If that happens, take profits off of the put and move on. Another thing we could potentially do with this position, now that the stock's up to 76, instead of just adding a call, I paid 19 for this. Okay, so right now I've got about $11, $12 profit. I could close this now, buy a 70 call for that $11 or $12. So we're going to sell the 45, we're going to sell to close it, and I'm going to buy to open the 70 call. There we go. Now I've got a no risk or bulletproof long call. And in this case, sure, you're missing out on the full $65 profits you have, but if it continues up as you're expecting, you're still going to be able to take advantage of that upside profit. If the stock falls, in this case, well, I don't have the benefit of the strangle if I'm wrong, and it does fall in this case, but I've locked in a guaranteed profit, and that's the worst case scenario if I still hold this all the way to January. Do nothing else, generate no income against it, and the stock's trading below 70, the worst I could do is profit $140, which isn't the gain you have right now, I understand, in that case. But depending on the price ratio and what looks up, you could, I would say in the same time frame just to keep it simple. And that also gives you time to manipulate the put and the call as it goes forward. It does cost more, of course, because you're paying in for more time value, but you're still in a good place to manage the position. Now, another option, as I showed you, is to roll up as we did here. You've got a locked-in profit of $140. I know it's not great. That's the worst-case scenario. But let me take, the bid-ask spreads are too wide. Okay, I was going to say, let me take some of that profit and buy a closer out-of-the-money put, or closer to your current strike price, and now I've got that low-risk strangle. So you took in some of the profit, you could still make it up, but if it really falls back down, you've got the strangle that you want. Evaluate rolling the call up first and taking that profit off the table, using some of that to buy into a higher strike call, and maybe evaluate buying a put on it as well. It's never a bad idea to add protection, don't get me wrong, but you might be able to, especially in this case, Dan, since you think it's going to continue to go up, you're kind of telling me that you want to stay in it for further upside. Just rolling up the long call to lock in some of the profit but still leave the upside open is a good play. Okay, and you're not risking anything, you're just not achieving the full profit. And then, of course, we can talk about, well, should you get into a new position? Well, if you've hit your targets for this particular position, and as part of your trading plan, you want to, continue that. Well, if you find another security that you feel is going to be as strong and as successful as your expectation for what you feel on the YRI.to position you're in right now, then that's okay. But if your expectations, what you're in the YRI.to call in the gold is going to continue to go up, then I'd look to maybe roll that call up, take some of the profit off of the table in that case, and look forward to maybe then buying a put as well. Okay. All right. So, uh-oh. Oh, no, I'm good. Okay. So, Octavio, he says, Mike, what's the best available tool settings to help me find and confirm some good bear calls to sell? Well, bear call credit spread screen. I don't have that up here now. If I can hit the right tab, Octavio, I'll show you. So let me clear out calendar calls for the time being. Add in bear call credit, first one on the list. Okay, go into search. Now, I haven't seen this over time. What I'm going to show you here, this search criteria, I haven't seen this over time be as successful as the bull put credit spreads, and that's related to the market conditions. When you have a bearish market, it's usually pretty fast and it drops pretty quick, okay? Unless you find a good 2 to 3 month time frame of a market decline, a steady market decline, the bear call credit spreads don't work that well. As I mentioned, I think we mentioned this last week, but I'm just going to reiterate it. Back in 2018, we had 6 out of the 12 months were negative markets. February 5th through February 9th, 2018, the first talks of the first round of sort of the Chinese tariffs and everything, that took the market down in that 3-day period. Then the market came back up until about March 20th through April 5th. It dropped again. Then it went up and then had a little hiccup on August 5th, if I'm not mistaken. And then it went up from August 8th or so to right about October. And then there was that horrendous October, tried to pull back in November, is a little bit bullish, and then that horrendous December. I didn't trade bull puts through that entire year of 2018, but using the bull put weekly screen, if I had invested $20,000, 20% of a $100,000 portfolio, I still would have had a profit of 9%. Not 9% of the 20,000, 9% of the whole $100,000 portfolio. $9,000 profit on 20,000 invested with the bull puts. The bear calls were still at a loss. Why? Because those 6 negative intervals happened over a 3-day period, a 10-day period, a 2-day period, then a 15 to 20-day period, and then another 20-day period. All the other time the market was bullish and the bear calls were losing. But if you think you're in a neutral to bearish market, want a high probability, this is the screen I'd likely use. I'd likely use the weekly bear call credit similar to the weekly bull puts. Still looking, no, I'm sorry. Let's increase that. We're still looking for that 85% probability or higher on the position. Looking for a good range out of the money, minimum return, and of course we're looking for stocks that are trading below their 20-day moving average with a negative MACD performance. That's what I would use. I have to talk to Ernie. I'm not sure if he changed that by mistake and put the probability to 70. That should be at 85. That probability should be at 85. I'll get to changing that soon. But in any case, this is it looks like very similar to the bull puts, 13%, 15% returns, 85, 87, 88% probability. What's usually good for the goose is good for the gander, but just remember, the bearish markets happen faster, more sudden, and don't last as long. Okay? So once the market starts to turn, you probably want to get out of that quickly, and even though you have this high 80, 85, 90% probability, once you see the market from your expectations start to go back up, it's a long, gradual, slow burn, but it does hurt the bear calls over time. The bear call structure, reverse of the bull put structure, looking for the same criteria, just reversing it, looking for the same 85% probability, same minimum 9% return, for example, things of that nature, but looking for the negative MACD and the stocks trading in a downtrend. It was profitable during those 5 or 6 periods, but it lost money through the course of 2018 with the same allocation, same setup, and same structure as well. But this is where I would start, and then you can tweak them, Octavio, to meet your needs. All right, so this is William now, I believe. Yes. Okay. William, I hope you had a good week. Honestly, everyone, I had a great week until about 20 hours ago. Strange incident right when we were putting the girls to bed. The 6-year-old said she smelled something weird. I couldn't figure out what it was. It was a burning smell. We couldn't figure out what it was, so to be on the safe side, we tried everything and tried to turn off some lights and some other things. It couldn't pinpoint it. I was hoping it was one of the air conditioner units. Anyway, long story short, so from 10 p.m. to about 12 a.m., we had the 2 fire companies out here with 3 trucks, and what ended up happening is apparently the motor in the ceiling fan in the master bedroom went bad, and that was the burning smell. But there was no smell in the attic. It was just coming from that. So that was good up until this point, but thank you. Yeah, I had a good trading week. Despite what has been happening recently, I had a good trading week. Good profits on the bull puts there, good profits on the married put position, some good management was available too. That Fabrinet position has reached profit, and I can roll the put again, actually, to bulletproof the position. I just was waiting for a little bit better. But thank you, Wim. I hope you had a good week too. But let's get to the point, folks. If you have the time, could you discuss how you manage 2-week bull put credit spreads that are near the money the day before the day of expiration? Do you roll out another 1 to 2 weeks, or do you close for a smaller profit or even slight loss? Do you wait till close to end of expiration day to see whether position will fall in the money or out of the money? Thanks. Okay, great. Well, this is in related to, I should say, the conversation we had earlier about the out of the money call for Henry, or the out of the money put for Henry. My same rules apply, and I kind of covered that. I don't know if you were here for that, William. But we were talking about the naked puts. And he says, if you've reached expiration, you've had near the max profit, would you close it? And the answer is yes. This is, of course, different. And we're talking about if I've reached my target point in that case. That's close. That's pretty good. Gilead's probably better, even though it's up today, but Gilead's probably better. So let me look at Gilead real quick. And let's see if we can still get the options in for today. Okay, William? Let's try that out. All right. Yes, beautiful. So let's say I had entered a 2-point spread a week ago or 11 days ago on Gilead. And we sold the August 69 put for 65, 69 put for 45, and bought this one here for 21. All right, so I'm still looking about a 14% return, 24-cent max net credit on the bull put credit spread. All right, but the stock is trading at 69.35. And before that, of course, we saw it was up about 50 cents today, I believe. It's not up there, but I believe it was up about 50 cents. So it was below the strike price. So here's the trick. I am pretty stringent, William, with my rules. And you've heard me talk about my rules. And the one rule I have is the 1% rule. Okay? Meaning if the stock reaches within 1% of that short put strike price, in other words, in this case, it'd be $69.69, $69.70. If the stock hits that price, I'm likely looking to close the position. Whether I'm 1 day away from expiration, whether I'm on the day of expiration, whether for a small gain or small profit, that's when I usually look to close. Now, if the position's been doing what I want, let's say it's still GILD was still hanging around, it'd been trading at $70, $71, $72 per share, for example, and I'm 2 days away to expiration, I might consider adjusting that to put it down to 69.35. In other words, 0.5%. So if the stock trades within 0.5% of my short put strike price, that's when I'd look to close the position, and I probably would have closed the position today. I would have had a small profit in this case. Yesterday, with it down to 68.85, this might have been at a small loss, and I probably would have liquidated because it was below my short put strike price, even though today it would have ended up being a full profit. Because what can't I do? On Thursday, yesterday, let's say the stock had been trading at 69.90, and then it fell $1 or so and was trading below 68. And it was 68.85, we're saying, or so, maybe 68.80, okay? Well, right away, we know this is probably going to be 30 cents or so to buy back. 1 day of time value remaining, 20 cents intrinsic. And this would be maybe 5 cents. So I'd close it out for about $25, or maybe 30, okay? We'll go $25 or $30. So I'm looking at a small loss here of, you know, $1, 1 cent in that case, you know, if you call it that way, or maybe 6 cents. Why is it a good idea to close then if the next day it's profit? Because you don't know. What if it went down to 67 the next day because it's been moving against me and going down? Now I'm at the full loss of 176 instead of 0.06, 0.10. We're at 1.76 at full loss. I don't want to take that chance, William. I'm likely to close it, even though, yes, the next day it could rebound and I could be at full profit. I would rather not risk taking 30, 40, or 50% loss on a stock that's declining on this spread if I can get out now for a smaller loss and it looks like it's moving against me and has hit both of my triggers. Okay? So that's what I'm looking for as well in that case. Let's see here. Oh, I'm sorry, folks. I just did something. I think I missed something here. There we go. I did miss something. Okay. All right. So in general, William, that's what I look to do. This will lead into Eric's question as well. So he says, Eric says, do you have videos outlining the bull put spread you're talking about? Yes and no. What do I mean by that, Eric? If you go to the webinars page, we always illustrate this here, but if I go to the webinars page, go to the home tab and go to free webinars, or you go to PowerOp.com/webinars.asp. This is a public page. Even if you're not logged into PowerOptions, you'll be able to look at some of the tools and some of the other ones as well. But just on a trial, the most recent 4 or 5 are blocked off for you. So we did discuss the criteria that we're using for the weekly bull put credit spreads last week for William, if I'm not mistaken. I can't remember. But in any case, we do have that there. But here's the idea, Eric. This is a public page. The most recent 5 are blocked out, only available to subscribers only. But there's probably 25 to 30 webinars in here that are available to the public, older webinars, but they're available. And if you scroll down here, I'm going to take you to the main ones. Okay, so you go to PowerOpt.com/webinars.asp, or if you just go to PowerOpt.com, I believe on the main homepage, there's a link there for webinars. You scroll down to the bottom, and the first one you might want to, I don't know. The first one you might want to check out is debit spreads versus credit spreads, and there's one here, how to be successful with spread trades. That's a good one. Where I think you might want to start off here is a discussion on credit spreads, the basics, and then really the main one is credit spreads beyond the basics, part 1. This is where I talk about the look at expectations that we've seen you should have and that work well, structure, criteria, trading plans, position sizing to help you be more successful at spread trading. So if you've already got a general knowledge of the credit spreads, Eric, the structure of a credit spread, and you have reasonable expectations, this is probably the webinar you want to start with. From January 21st, 2019, Credit Spreads Beyond the Basics, Part 1. You could probably just go to our YouTube channel too and run a search for that term, Credit Spreads Beyond the Basics, Part 1, and it'll pop up. After that, you probably want to go to this one here, 8 Ways to Manage a Bull Put Credit Spread. This goes into a little bit more discussion of what I just talked about with William. But how did I just get away from that? Sorry. But it's our preferred 8 ways to potentially manage a bull put spread. Sometimes, William, I might roll, but usually if it's moving against me and it's fallen down to that price, I am more apt to just close the position and move on and look for something the following day or the next Monday after that expiration cycle that matches my criteria. But we discussed the trigger points to know when to consider managing or closing, pros and cons of each adjustment, of course, the 8 ways, what are the 8 adjustments, all shown on a current trade. All right, but the full specifics of the bull put credit spread approach. This gives you some ideas, and it talks about, again, as I mentioned, the proper expectations, structure, trading plans, and more, Eric. But the full approach that what we're talking about, where some investors have gleaned what I've been doing and we've talked about on some of the webinars, that full discussion of everything is going to be available in a course, educational course product eventually soon as well in that case. But it's not in a full webinar. But those webinars will give you an approach, that guidelines for the approach that we're talking about, Eric, and ones that you may not have seen before. Okay? All right, so let me make sure I've got a lot here. There's William's question we just covered. There is Eric's question that we just covered there. So credit spreads beyond the basics, part 1. Sorry about that. And then just below that from January or September 2018, 8 ways to manage the bull put, credit spread, including triggers and more. Okay. All right. Oh, okay, good. So William had a follow-up. Thanks for the explanation. If the stock falls within 1% early in the trade life, say 1 to 3 days after you've opened the position, will you close? Yes, because I'm getting very, very close to what I can't take. And that's more than a 50% loss on the position. Okay. I want to control the losses on the losers to be around 45, 50% max. I don't want to take a 60, 70, 80% loss if it continues to go down against me. What do I mean by that? Well, I showed do I still have it up? No. I'm sorry, I might not have it up. I apologize for that. Oh, wait. No. Okay. Let's go back. And GILD. I almost hit the call again. I'm trigger happy to the left-hand side here. I'm almost entering a bull call debit spread, not a bull put credit spread. That would be okay, though. So we did 0.45 and 0.21. Am I right? All right. So let's go back. This is the position today. I should have used the other one. Okay, but that's okay. What do I mean by 50%? I'm targeting in that search. If I opened a bull put, what we like to target in the search is an 85% probability of success. And we're looking for returns around the 17, 15, 13% range, okay? And what do I mean by a 50% loss? The most I can lose on this one is $1.76. So I'd probably be apt to close this position. I would close this position even if it didn't hit the 1% rule, William, okay? If the stock was declining fast, it started to move against me fast, and I could get out of this for the liquidation cost was 88 cents. Half of the maximum loss I could take, roughly 4 times the net credit I'm taking in, I'm going to close this position. Is that roughly going to wipe out 4 previous gains? Potentially. But it's not wiping out 7 or 8 previous gains if I let it go to full loss. That's what I can't take, okay? Let me show you why real quick. There's this neat little tool, of course, we have, William, and this is how I started developing what I wanted, but knowing what I wanted with the bull puts and what target I was looking for. At radioactivetrading.com, the other service we offer, we have this trade simulator tool. And it's a simulation of 100 trades. Flip a coin, heads you win, you make your target return, tails you lose, and it runs the simulation over 100 trades. So if I'm targeting average of about 14.9% return on my winners. All right, I'm going to cheat a little bit, but 45.9% on my losers, and I am right 85% of the time. I'm going to take $10,000 and allocate 33% to each trade. Okay, we start off with $10,000 and a series of wins and losers. Head we wins, tails we lose, and so forth. But you can see with the proper win-loss ratio, I'm expecting a high return over time. You heard Sam say in just 8 weeks, he's over 70%. Was it 8 weeks, Sam, or 8 trades? I can't remember. He's over 70% with the bull puts. Robert made his comment in. It's been the right market for it. If the market turns as, oh shoot, was it Octavio who asked about bear calls? I'm sorry, guys. I'm getting everyone confused. I apologize. But when you're talking about the bear call credits, if the market does turn, and it starts to go bearish, meaning I see the broad market indicators, the SPX drops below its 20-day moving average or the 50-day moving average, and the MACD goes negative, I might not be opening bull puts. But what am I getting at here? This is essentially what I've experienced with the bull put spreads. Actually, that win ratio is too high. It's 84%. I'm just saying if it comes up. It's 84% is what I've seen. Sometimes, some years it's 88%. Some years it's been 83%. But I think the average over the 6 or so years I've been doing is about 84% winners. And I've controlled the losses. I'm sorry, that's wrong. It's 49.5. Under 50%. It's 49.5. But that's what we sort of target in the trading to look at the proper return. Okay? Why am I sharing you this? Because if I slip up and I allow a couple positions to go to a 70 or 60% loss because I didn't close based on my plan, or close when it's a 50% loss, and that increases the total loss percentage to 65% from 50. Where am I? I'm actually at a loss over time. It's too high. I can't allow that to happen. I use this as sort of my guide of what I need to target for my gains and loss, knowing that I'm getting about an average of 15% return. It's 14.9. And I need to keep my losses to 50%. And if I keep that win ratio right, 83, 84%, I have the profit target I'm looking for. If I'm wrong, or I don't follow my pattern, I let a few go to an 80 or 90% loss of the 15 times I lose over 100 trades, and that increases my losses to 65%. I'm losing over time. I started with $10,000, and outcome of, yeah, and it was successful. It looks like I have a great track record at one point, but over time, that is too much to lose. So I keep that at 50. When my positions hit 50, well, let's get back to that 83%. My positions hit a 50% loss. I close them out. I keep the same win ratio, and the drawdown is not as severe. If I allow the risk to go too high, even up to 70% is way too high. You can obviously see that. I mean, you're almost bankrupt. I'm down 80% with an 80% win ratio. Can't allow that to happen. And this is also true with what I've seen with other positions. Some investors have asked, and many of you have asked, and we've gone through this discussion, we're talking about the bull puts, looking for that 85% probability and seeing it long term. Okay? And they say, well, can't you do better? Why look for an 11, 12, 13, 14, 17% return if you can get a 25 or 30% term with a 70% probability and still be 3% out of the money? Because when you run those numbers, what do you do to get that higher return and lower probability? You're closer to at the money. You're not at the money, but you're not as far out of the money, right? You're maybe only a couple strikes below. So if the stock falls 3 or 4 points, you're going to be at your trigger to close. And yes, you might be making 25% when you're right. But because when those declines happen, they happen faster, where I'm closing out for a 50% loss, you are closing out for a 70% loss, and you might only be right 75% of the time. And okay, so if you're above 75, you're at 77, you still have a small profit. You made $600 after 100 trades. We were at 25,000, okay? Here's one at 78. There we go, 73%. Where are you? You're down 73%. 73% winners. You're taking losses at 70% because they're going through the strike prices too fast. Yes, you're targeting a higher return with a higher probability, but you're also going to be wrong more often, and over time, even a 75, I'm trying to get to 75, even a 76% win ratio over time, even though you had a successful track record, it looked good at one point, over time, it's a losing proposition. That's why we target the 85% probability. That's why I close when I get my 50% loss on the spread, even, William, if it's in the first day after I open the position. Might roll down, but again, why roll down? If the stock's going against me, why roll down? Okay? All right. All right. So, William, you went on. So this is a different comment. I might have missed this one and skipped over it. But you said earlier today, you mentioned that your preferred goal is to close for 80% of full profit. How do you decide whether to take the 80% of full profit versus letting the position expire OTM? When you show the radioactive trade simulator tool, run your simulation based on taking full profit. Yeah, no, that is the average profit I had is 14.9% the last few years. How are the results affected by only taking 80%? Okay, I'm sorry. All right. Okay, let's be fair. 49.5, 15, same allocation, and okay. This is an argument we've showed recently, William. When we're talking about the weekly bull put credit spreads, I know some of you out there know that when you're talking about the one-to-one debit spreads, the 30 to 60 out debit spreads that are at the money, that have more of a one-to-one or only 2-to-1 risk-reward ratio, the suggestion is to close at 50% profit. I can't do that with the credit spreads. Why? If I closed all my winners at 0.5%, guess what? The ones that lose still lost, and they never hit the 50% gain. These ones lose because the unexpected happens on the stock or in the market, and those stocks just suddenly fall against you. The market suddenly falls against you. I'd still be losing 15% of the time at an average of 50%. If I cut all my winners in half, look, well, let's get up to 85. Look at that. 50% loss, 45% loss. I can't do that. That's one of the goals. I can't allow the risk to go too high, and I can't limit the return. For my structure only, looking for the 85% probability, cutting the winners in half, and I'd say over 100 trades, only stopped 1 or 2 losses. That's it. It didn't push me into the 90 percentile probability or 91. If you run a search with a 90 or 91% probability and you're targeting a 7.5% gain and you're able to see that, if you're right 90, 92% of the time, you'll experience it. We saw how fast it was. 87 is a loss of 20%. 93 is good. 89, okay, there's one you can still be profitable in that case. Okay, but you're right. If I'm looking for a 90, 91, 92% probability, I'm only seeing returns of 6, 7%. Okay, this is still successful, but again, with the testing that I've done and the trading that I've done, I've seen the success. And again, this is my target, so you can play around with it to find yours. That's way too much. Let's get to 83 again. 81, 82. I want to get to 83. 82 is good. 83 is better. That sounds silly. There we go. Okay, great. Now, 80% profit means that the ones that were winning that went to full profit, I closed earlier consistently. Now, when I say 80% profit, William, I think I covered this in that conversation. I did think I said that if I was 1 to 2 days to expiration, I'm at 80% profit, and I'm still well out of the money, meaning I'm nowhere near that 1% rule. I'm probably just going to let it go to full expiration. I did mention that I want to see full profit at expiration on these weekly spreads, okay? So let's say 80% of the profit, and half the time I take 80% profit, okay? So let me just do this here. We're just going to do it this way. I can't think about it mathematically in my head. So, I'm sorry, 15% times 0.80, that would take us down to a 12% return. But let's say we only did half of the position. Only half the positions were of the successful ones we closed out for an 80% profit. So instead of 15% return, I don't close them all and lower it to a 12% return. We go halfway between. Okay, so $1.50 between. So it'd be about $13.50. What happens if half of my positions were closed and I lowered my return to $13.50? I'm still profitable. 83, 84% success rate. You know, I'm just dialing down that number. It's not going to increase the number of winners because the ones that I'm closing at 80% profit are likely the ones that went to full profit anyway. We saw some scenarios at 83% success rate that was at 21,000, 22,000. This dropped it down to 17. But that is also dependent on the strings of winners and losers. Okay, if you have a couple losses in a row like we do here, that affects the total outcome. Okay, what if I dropped it down to 12? That same 83% success rate, William. And this is a public thing too. You guys can do this weekend on your free time. 84% look, it's down to 15,000. Still profitable, but not as high as we were seeing. I'm trying to get to 83 to be even. But again, even at 83%, it's based on the strings of winners and losers. If I have more losses right off the bat in the beginning, William, it's harder to get that money back and get to a higher profit. Yeah, okay. I'm not going to get to 83. It's going to be mean to me today. Just one more. Come on, give me... All right, we'll stick with 84. And so it was there, but now we go back to the 15 in that case. Sorry about that, folks. Go back to 15, and it's at 33. It's almost, again, it's dependent on the strings of winners and losers and when you hit your losses, how much you've built up to protect, or if you hit the losses right away where it's harder to build back, William. But that's the effect, right? We saw it at 84% success rate. At 12%, we were looking at a 15,000 return of 50%. Still great. But there's higher numbers here, right? You can run those numbers for you once you find what you wanted to isolate and then play around with those ones as well, okay? Okay, Octavio says that he's been closing his naked puts at 50 to 60% profit. There's nothing wrong with that, okay? Octavio, there's absolutely nothing wrong with that. But for me, I found that with the structure that I use and what I'm attempting to achieve and the targets I have with the bull puts, I'm more likely to let most of them go to full profit rather than close at 80%. But if I'm 5 days, 6 days into the trade and still have 5 or 6 days to go to expiration and I'm at 80% profit, I may take that one off the table and maybe open a new bull put at that same time for stock that has the trend that I'm looking for. Or maybe even roll. It depends. But 1 day, 2 days before expiration, if it's not threatening my 1% stop rule, it's not threatening the strike price, still positive MACD and is above the 20-day moving average, I'm probably holding it as long as possible to try to get it to full profit. On a collar spread or on a short call, an income method number 1, I may have sold against the married put position. I might take 80% off of that, but usually I'm selling 20 to 30 days out, depending on the stock, William. So if I have 80% profit in the first 10 days, I'm probably buying back that call and rolling up to a higher strike price in that strategy. But with my weekly bull puts, I am more likely to go along and hold it for full profit unless my 1 or 0.5% rule is triggered and unless something else along those lines, okay? All right. Well, that's disheartening. Sorry about that. Hold on, folks. I'm sorry. My apologies here. There we go. It doesn't look like we have any other questions coming in. I think we've got through all of them. I'm just making sure. Yeah, I think we've answered all the questions. So I just want to remind everyone that today's material are my thoughts on your questions designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions or recommendations. I'm not opening another bull put on GILD. We just use that as an example. Options do involve risk and may not be suitable for all investors. If you like some of the tools that we saw today, we looked at some of the search tools and the criteria for bear call spreads and for the bull put spreads. We looked at that. We did an in-the-money covered call screen. We ran our what-if scenarios, and we looked at the portfolio as well. But if you haven't done so yet, remember you can take a 14-day free trial at any time for no credit card needed. I'm sorry, no risk, no credit card needed. Just go to PowerOp.com, just name and email only. You'll be able to access the full tools for 14 days. After that, subscriptions start at $45 per month. And of course, we do offer different levels of service. If you wanted to view more of the historical backtesting data, if you want a real-time service, that's available. Of course, the education that we talked about there, the education on the credit spreads, debit spreads, 8 ways to manage the bull puts, and management techniques for covered calls, just long calls and long puts, naked puts, all available on that webinars page, powerop.com/webinars.asp, under the strategies section. You can also go to our YouTube channel and run a basic search as well for different, if you just wanted to look for, hey, calendar spreads, poor man's covered call. You'll probably see some webinars that come up based on the title name as well. You can always check out our blog also. Real quick here, let's see here. Okay, William says, thank you, Michael. Very thorough. Much appreciated. You're welcome, William. Have a good weekend. William, you do the same. And Vin, you say had a great, safe weekend as well. Thank you. I will. Vin says, oh, you're welcome, Vin. Chuck says, just to clarify, your 1% stop is what you use for credit spreads. Yes, if the stock reaches within 1% of my short option strike price in a credit spread, that's when I'm going to consider closing or adjusting the position. That's my first rule. If I hit the 1% stop rule and the stock has dropped below its 20-day moving average and the MACD has gone negative, I'm probably closing immediately, Chuck. It's 3 strikes and it's out. That's hit my 3 stops, so I'm probably out immediately. The 1% isn't always a hard stop. I have to take into account when that happens. Was it related directly to the stock? Was it an overreaction from some news that came out on the sector the stock is in or the market as a whole? I may not close, but when I see that it's hit the 1% stop and I'm at my 50% of my max loss, I'm out of that position because I can't allow it to go to 60, 65, 70%. Okay? We saw the reason why they're going over that. All right. So that's mine for credit spreads. All right. Oh yeah, he says enjoy some crabs this week and I miss them. Oh, we hope to. We hope to. So there is no going to be any webinar next week. All right. As Chuck kind of alluded at, I'm going to be going on vacation tomorrow at some point related to what happened last night. I mentioned with the fan, we have an electrician coming out to check the wires tomorrow, so our departure time drive-wise is going to be delayed until that work can be evaluated. No webinar next week. What I am going to try to do, and I know this sucks. Well, I don't want to say sucks, but I know that you guys might hate this a little bit. I am not going to have the time to trim this webinar into multiple sections. I might get 1 or 2 done tonight in the early morning. I'm going to try to cut it up a little bit, but most likely you're going to see one giant webinar that's an hour and 45 minutes long, but in the description, I'll have the sections cut out for you. Okay, so you'll be able to read what each section was. But I won't be able to split this one up because that usually takes me a few hours to do, and I don't think I'm going to have the time. So in any case, there won't be a webinar next week, but remember, I will be checking email. Ernie will be available. Greg will be available for coaching. So just send us an email anytime with any questions to support@powerop.com or support@radioactivetrading.com. Call the office during market hours as well. And remember, trial members and subscribers, you can always schedule the coaching sessions as well. That will likely be with Ernie next week also. All right, ladies and gentlemen, take care. Everyone have a safe and fantastic weekend as well. I'll see you or hear you in a couple of weeks, everyone. So take care, and we'll see you all soon. Thank you all. Yeah, I'm looking forward to having a good time there, and we're going to try to be safe, and I hope you all stay safe as well. Take care, everyone. Good night.